Okay, so here we are in early 2023, and we're already seeing some articles and some commentary and a little bit of debate with respect to what's going to happen this year with respect to the housing market. And, there's obviously different positions out there by different groups and people, economists, journalists, analysts, companies, etc. So, are you on the side that we're going to continue to see appreciation and things will be all right? This market will self correct? Or are you of the opinion that we're actually going to continue with the correction and maybe actually have a crash this year? So today we're actually going to look at what I call them Zillow versus Moody's, appreciation versus housing correction crash. And we'll kind of take a look at an article that I thought was kind of interesting. And you can see the difference in opinion from two different organizations. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism in real estate. Today's the 25th of January. Hope you're all doing well. Guess what? This video is brought to you by our friends at Foreclosure.com. This is my affiliate link, so go to GetHousingData.com. That's GetHousingData.com to check out the pre-foreclosure, foreclosure, tax deed, distressed property listings in your neighborhood. All right, guys, so we're going to go right from there. Fortune.com, as I mentioned, Fortune's put out a lot of great articles the past 6 months with respect to the housing market. They've been pretty detailed. It's really good to see. So basically, we're going to talk about, all these markets that are expected to shift, during the year. And we're looking at two perspectives, one from Zillow and one from Moody's Analytics. And, what do we know about Zillow? Well, Zillow does what? Zillow, has real estate services. Zillow, how to buy and sell iBuyer operation. Zillow has estimates. Zillow has listings. Zillow has sells ad space to real estate agents and other companies. So Zillow's all about real estate for sure. Moody's Analytics, well, that they're chiming in obviously because they are a financial company, and they I guess look at everything that goes on in various markets across the country, including real estate and the housing market. So they chime in with their 2 cents worth of information, and obviously they're probably paid by many of their clients to provide input as to where various markets are headed this year and beyond. So we're going to have two probably very different perspectives going on. So ultimately, just to sort of quickly summarize, we're seeing the fact that Zillow said that they believe, or the Zillow economists believe, that U.S. home values will fall just 1.1%, basically from November of 2022 to November of this year. So just falling 1.1%. And that's really not much at all. I think that's really a non-starter as far as I'm concerned, whereas Moody's expects U.S. home prices to fall to 10% from peak to trough. Now, realize that this is national across the board. So, and every time I talk about this, I know there are people that will comment and say, "Hey, well, my market, I'm seeing this is not happening in my market." Okay, I get that. This is a national sort of broad-based sort of discussion point here. When you go to Case-Shiller, for example. Which, oh Lord, I'm thinking it may have that may have came out today as well too. So I'm probably late in my review of Case-Shiller. But the point I'm making is that the Case-Shiller has goes into 20 different markets in their index, but they also talk about the broad base, which I sort of look at, and that's how I sort of comment on the overall housing industry. So we're going to take a look at what these two are thinking here. So basically, this is Zillow, how regional home values are expected to shift over the coming year, according to Zillow. Obviously, you can see that this is a heat map of the U.S., various counties across the U.S., and we can see that the green, or when you're on the green side of the coloring in each county, that shows appreciation. And they're expecting some markets still to appreciate, some possibly in that 5 to 10% range. If you go the other way towards the left, which is going to be kind of a burnt orange, amber color to sort of rusty color, as it gets darker, that's losing market value share. So if you take a look at that, we have a pretty decent mix of green and the sort of orangey color, and a lot of it is sort of lighter green and light orange. You don't see too much on the left and right extreme sides here. So which goes to show that their 1.1% sort of prediction is fairly loss of 1.1% is pretty, I guess, conservative, I would say, in this case. And again, when I look at who this group is, well, guess what? Their business is real estate. So nobody who really has a significant interest in the real estate world, like a Zillow, is going to come out and tell us, oh yeah, we're going to lose 20, 30, 40%, in various markets, and 20% on average across the board nationally. There's not going to say that. Why? Because I call it the corporate suicide. Like, in other words, you don't want to disrupt your base, your customers, your income, your opportunity, right? So, if they went and said we're going to have a market crash, they're going to lose probably a lot of, agents, real estate agents, I guess you could say, advertisement money coming in. That's going to affect their bottom line. So, this is what we see in these marketplaces, is that, those who have an interest can create their own narrative. So if you want to, Zillow is telling us that they see basically, 1.1% loss over the course of the year. That's, as I said, that's immaterial to the marketplace, and that basically says it's pretty much the same. Nothing's going to change. So go ahead and buy that house now because things aren't changing. So that's what Zillow is really saying to us right here. When we take a look at it here, and again, we all know we can take a look at their projections. Some are still going to increase. Some are losing, like San Jose and Texas and San Francisco. Others will increase, Atlantic City, Homasa Springs, Florida, Yuma, Arizona, etc. But this is really when they take a look at sales volumes and this and that, ultimately it says here, the possibility coupled with still low inventory by historical standards provides the basis for Zillow's forecast, continuing to rule out the possibility of a double-digit price decline in 2023 for the nation as a whole. So, again, when everyone's going to go back to, well, we have low inventory, there's not enough sales going on, so if sales pick up, that's, we're still going to have price wars, etc. So, and competition for that lack of inventory. So that's their position, which you have to respect, but that's what they're saying. So Zillow's saying really no housing crash, and looks like a bit of a loss, but I would say they're sort of banking on more appreciation than they are crash or correction for sure. So let's go a little forward here and take a look at our friends where at Moody's Analytics. And again, I don't do business with any of these companies. I just like to read their information. Now, if you take a look at what Moody's is saying here, it's a little different ballgame. All right, same heat map, same range of negative 10% loss to positive 10% value increase, from the burnt orange, amber to the green. And if you take a look across the board there, I don't really see any green on the screen. So sometimes as men we are a little bit colorblind, but I still don't really see any green out there. Obviously, a lot more of the orange, and a number of locations have some pretty significant, darker locations, darker burnt orange locations. You can see some in Florida, probably some in Tennessee up there. You can see middle, looks like the Arizona area, probably Boise or the Idaho area. Looks like something in part of Oregon, So you can see that there's pockets, like primarily we're seeing, over the 5% range, etc. So it's consistent with what they said. And, I can say that these guys are a little more bearish in where the housing market's going to go. Moody's has commented for the past 5 or 6 months quite regularly on various markets and what the losses are, etc. So to date, so we've seen an evolution of, we're going to see 90 markets lose, now 200 markets to 300 plus markets, to now we're seeing San Francisco lose 12, 13, 14, 15% right now. So things are changing. So this is, again, is their prediction, and their prediction really is Q4 2022 to Q4 2023. That's kind of what they're relying upon here. But again, it's interesting when you take a look at the difference, right? And that's sort of what we have to kind of figure out, is that there's lots of people chiming in on where the housing market's going to go. And as I always mention, when you take a look at real estate as a whole and what real estate contributes to the gross domestic product, the GDP, real estate contributes a heck of a lot to the GDP. About 25% of the GDP is made up of real estate and related activities. For example, you buy a house. Well, guess what? You buy a house, that means primarily you're getting a mortgage. So you're using lending. You're paying a mortgage broker or a bank. You're closing with a closing entity, a title company or escrow company. That's generating revenue and opportunity there. Oh, real estate agents get paid commission. Okay, guess what? You're probably going to have a home inspection. You're going to have an appraisal. So all those things generate income and opportunity for people that are participating in the real estate industry. What happens when you buy a house? Well, you got to move, right? So you're going to have, moving expenses, of course, truck rentals or mover rentals. You're going to do decorating. Maybe you'll do some fix up. You're going to go to Lowe's, Home Depot. You might buy furniture. You might put things in storage. I mean, so if you take a look at, what actually happens, doing some landscaping, cutting your grass, buying lawnmower, buying tools, depending on what you're doing. So as you can see, when one house transaction makes up a lot of touch points for the real estate industry and the services that sort of go along with it. That's why it's an important part of our overall U.S. economy. But again, going back to Moody's here, they're a little more bullish on the fact that we're going to see some of these markets that had high price appreciation are going to start dropping, and then everything else will sort of fall into place. Locations, they say, like Baltimore and Chicago, will fare better. And the reason being because they've already been hit pretty hard, and they haven't really had much price appreciation in the past couple of years, so they don't have much to fall or far to fall down. Whereas like a Phoenix and a Boise, Idaho, and a few other locations, Austin, Texas, they've gone up exponentially, and so the harder you go up, the harder you're going to go down. That's what happened in the last housing crisis. So that's kind of where we're at on things. So in the end, for me, it's personally, as I talk about this pretty much. This is what we talk about every video. But I'm more of the influence of a financial Wall Street type analytics group to spewing out information. Because they don't really have a horse in the race, right? Like, in other words, yeah, they have clients, and I'm sure they provide this information to maybe hedge funds or home builders or other groups that are involved in the real estate industry, but they're not necessarily selling products or services in the real estate space that we are as consumers are consuming, so to speak. So that's why I tend to sort of rely upon the sort of analytics and those type of groups more than I would say a mortgage company or a lending company, CoreLogic, National Association of Realtors, in this case Zillow as well too. So I just think that again, some of the narrative we can control. You're obviously going to do what's best for you, your income, your organization, etc., as a protective measure, and for your client base. Simple as that. So in the end, that's what we have. You're always going to have we're not going to have much. It's going to self-correct, and we'll be fine. We'll actually see some appreciation, or no, it's going to get worse. And we're going to go down the rabbit hole a bit more with this. Now, I think from what we've been hearing over the past few months, there seems to be a general consensus that we're going to have about a 20% minimum home price decline over the next little bit. We're already on the way down. Various markets are getting affected right now. So that's kind of where we're going to be at with this. Now, talking about that, I always share statistics. So, by the way, guys, if you like the stuff I provide, if you can smash that subscribe button, I really appreciate that. And if you are already a subscriber, could you please verify, double check, and hit the subscribe button again, because I lose subscribers all the time. Thank you very much. Okay, so guess what also came out last week was NAR, National Association of Realtors, put out their existing home sales report. So what this really means in the report, the nuts and bolts of it, were basically sales activity is coming down to a crawl. Okay, we've had 2 months of, we're seeing negative sales activity, like year-over-year sales activity is declining on a pretty steep basis. So what they like to do is provide like a SAR, a seasonally adjusted annual rate of activity, sales activity for the year based on the month's activity. So projection based on December sales activity is about 4,020,000 units sold per year. If you project that out, it's a far cry from the 6.5 we've seen a few months ago, and it's bringing us back down to what we call pandemic type activity when things were pretty much shut down. So that's where we're at right now. So sales has definitely dropped. The median price point, as you can see, was a high of 413,000, almost 414. Back, it looks like in June, May and June, and we're dropping down to 366 now, kind of like back in 2021. And so we've seen a little bit of a recovery in that perspective. So the median sale price for homes are coming down. What do we got here? Well, sales activity, existing home sales median price. You can see that it's year-over-year activity. It's still, this is the unique way of saying this, it's still increasing year over year, but the pace at which it's increasing is dropping rapidly. You can see that, it's gone from a high of, 15, 16, percent annual year over year increases now to like, 9, 9, 8, 6, 4, and now we're at 2.3%. So based on this trend, we're going to be basically seeing year over year maybe get into the negative to actually go the other side of the graph shortly. We'll have to find out. Existing home sales percent change year over year. So we can see that the volume of home transactions has been dropping at a fairly rapid rate. And I don't know if January will fare any better. January typically is a little more robust month than December is with sales activity. Realtor confidence, first-time home buyers, a little bit more than last year. Sales to investors, a little bit less than last year. Cash sales up a little bit more than the year before. Distressed sales, which are foreclosures and REOs and short sales, about the same. Days on market, we've gone from 19 days on market till contract to 26. So it just means it's taking a bit longer for something to actually get into contract and eventually get sold. So that's actually creeping up a bit now. It's an extra week added on to where it was this time last year. So a percent change in sales by range. Well, basically everything is down when you have overall sales of 30% loss in volume, but you can see the different segments on price points changing. So we're seeing obviously the 500,000 and above area being hit pretty hard with the lack of sales, and again we're seeing in the more affordable housing still at that negative 30-40% almost changes. So again, not much activity across the board, but we're seeing it particularly in the higher end homes, and that might affect the median price point as well too. Inventory. So yeah, we're seeing inventory. Different markets are going to have an increase in inventory at different paces. We are at 3.4 months of inventory projected out here in December. How inventory or how real estate works with respect to inventory, which is units per sale, it goes on a time, it's I guess described in months, okay, in months or time. So what it really means here, when we see 3.4 months, if no new listings came on the MLS as of today, it would take 3.4 months at the current sales activity pace to have all those properties get sold, and we have nothing left in the MLS. So that's where we're at. So 6 months, based on most real estate analysts and housing analytics people, 6 months tends to be the agreement area of where we have a balanced market. There's enough information out there, there's enough activity out there, and volume of homes available that satisfies both the seller and buyer. And it's not one market favoring over the other, so it's not a seller's market. When you're at 6 months, right now, still a bit of a seller's market, but that's creeping up. Sellers are going to have to still do what they need to do, buy downs, concessions, whatever that is, to move the property, because interest rates really don't. I mean, they're going to adjust and fluctuate a little bit here and there, but guess what? According to the Fed, they're not coming down anytime soon. All right. That's why this year we're going to have a lot of distressed property opportunities. The foreclosures will manifest. And what's in it for you guys? Well, guess what? More foreclosure auctions, more stuff coming to the auction being available if you want to do that. A lot of those homes are going to come back in the marketplace as what we call bank-owned or real estate owned. So you'll be the bigger, more foreclosures mean more REOs in the marketplace. More short sales will be available. More short payoffs, which are kind of like short sales, but a little bit different. Subject to taking the property subject to the mortgage. It's not a mortgage assumption. It's just a different way of doing things. So if you want to find out how that works, let me know. We're going to see more homeowner association and condo association foreclosures, because when people are in financial difficulties, they don't pay their assessments, they don't pay their monthly fees, and those groups can actually foreclose. We see a lot more probate estate foreclosures. That's increasing now. And we have something what we call foreclosure surplus or overage. So, for example, if there's equity in your home when it gets foreclosed on, and say you owe $300,000 and it gets sold to the lender, and that's your final judgment, and it gets sold at the foreclosure auction for $350,000. Well, that's a surplus, and that surplus, isn't the homeowner who owned the home is entitled to that surplus. The lender can only take back what was owed in the very end. That's the final judgment. So there's a surplus out there. So homeowners do not get a letter in the mail or a check in the mail that says, "Hey, your home went to auction. Here's a surplus." It's a little different. It doesn't work that way. You actually have to apply to the local county to ask if you have surplus. If there is, they can issue you the difference. But most people vacate, they leave, they're moving on. They don't know this is available. So it's a very interesting opportunity to help them, get some of that surplus if it's available, and you can get paid at the same time. So anyway, just neat things to think about. These are the opportunities and more that will be going on this year. Open again, FYI, as I always say, open for business. What I mean by that: new home construction, existing MLS properties, investment opportunities, cash flowing, Airbnb, fix and flip, single family stuff, multifamily, build to rent, flip, Also, I have finance guys, lenders, hard monies, the whole bit. So full service here right now. We can satisfy your purchase, listing, or investment needs. So guys, here it is. A lot of stuff on the go. Connect with me if you want more information. I'm still looking for various agents in Florida and other relationships across the country. So please, jump on what I'm talking about before the masses get here, and you'll be ahead of the game. So, by the way, thank you for the views, likes, and comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. We'll look forward to speaking with you later on this week. Thank you.